Hello YouTube! Today we're going to be talking about how the bears are making history. Why? Because we have a bearish 12-month or 1 year engulfing candle. This has not happened ever since SPY or the SPY managed ETF started trading back in 1993. There were a couple of times where we had bullish engulfing candles, including 2020 and also in 2016, but the bears are making history by having that bearish yearly engulfing candle. I think this is so important for us to be looking at because if we are very zoomed into short time frames like a daily chart, a weekly chart, we can often forget the bigger picture. And this is so important because our bear market targets of this year have been largely hit. And as we're looking to the next levels of support and resistance, we realize that, oh my goodness, it's like 350s coming in next. Absolutely. So I just want to make sure that people understand where we currently are, because until we're able to reclaim the 2020 high at about 379, there's not really much for us to talk about. It's a matter of how low and how painful it's going to get. I know that's not the story many people want to hear, but our goal is to provide accurate information. It is not to tell you what you want to hear. So we got a lot to go through this weekend, and I think a lot of people were really watching closely to the 200 weekly on SPY. But even me, because I was a little bit too zoomed in and now looking at every chart, I kind of missed a more important chart, which was the Qs. QQQ. Which got within 10 cents of actually testing its 200 weekly. At 271.93, we got to 272.02. We did get that end of day rally, but all this tells me is that we're like looking pretty soft here. We're not really looking all that strong. We got bearish volume, we got bearish price action, which means the bears are pretty much in control. So that's going to be very important for us going forward here. I would also note that SPY is closed below -20, or what? Bear market territory. That is going to be our blue line here. Saved it by a whisker last week, and now we did not. 384 is going to be our bear market area. So until we get out of bear market territory, what are we? We are below our 2020 high. We are below, we're below our 2020 high and also below our 2021 low. That is like really easy to understand if we're not hyper zoomed in. I would also look here at QQQ or the Qs and look and see that, oh crap, right? We're actually closing -30. And we've only done that on one other week where we got an immediate snapback. I don't know what's going to happen this week. All I know is that closing at -30 on a weekly closing basis, bouncing off the 200, if we cannot find buyers here, I do not know where we're going to go. I'm thinking that we're going to go down to -40. And it's really important to note that when we were talking on Thursday about if we start slicing through the next $10 area, because let me actually go back to here. SPY 1 week. Let's delete everything and let's just show you the chart we did before where we had that big support video that went out, I believe, on Tuesday. And then on Thursday, we were talking about what we needed to hold. So here we're going to look at just the round numbers. We're looking at 360. We're going to be looking at 370. And then we're going to be looking at 380. So let's snap one more line in here. And what's this low right here? 380. So as soon as we lost 380, we're now going to look at a daily chart here. So we're going to zoom in. Almost like clockwork. It was like a magnet. After we lost 390, boom, right to 380. After we lost 380, boom, right to 370. After we lost 370, boom, right to 360. We're losing like 10 points a day. That's like a lot. So now the question is, what is going to happen if we lose 360? That sounds a little bit scary. And yes, it is scary because this means that we're now entering a new normal for the stock market. Similar to what Jerome said, again, Jerome Powell, when he said that the economy is entering a new normal post-lockdowns. And we also have to remember that there has not been a bullish engulfing weekly candle. Actually, there's one right here. Other than these ones, ever since we formed our all-time high, it's pretty much red volume, red price action, which means what? Bearish. So we're going to make our best effort to get you prepared for this week ahead. I'm a little bit under the weather today, so I would really appreciate if you could smash a thumbs up, drop me a comment, and subscribe to the channel to show me some support, please, and thank you. So now let's start going through here. All right, let's jump right into the bear theme. So here we go for the bears. 2008 versus 2022, we have a 91% correlation, and we have an 85% correlation going back to 1973, which means that history does not repeat itself, but it rhymes. And 91 and 85% correlation, absolutely, we're seeing a rhyme here. This is rhyming massively. We can also note that last weekend we went through and talked about our 2008 versus 2020 comparison. And you saw it here. This is a line chart, which just means that we're looking at again, we're not looking at the total price. We're just looking at a weekly closing basis, which is what I'm also using for my psychology chart. So if it's so correlated technically, and now we look here to our charts, we knew that we have bearish engulfing weekly candles. Once we get our one bullish engulfing, that's it. We go lower. We lose our green line, which we have now, and we're right here at about the 200 weekly. This is from about a week ago. So we look here to our 2008, and 2008 told us that we have pretty much the same thing. We have the exact same pattern or head and shoulders. We lose the 50. We reject off the 50, which is exactly what happened in 2022. Head and shoulders, reject off the 50, reject off the 50. That's it. Looks very similar. Now we look at the next part. We look at the next part here, meaning the bearish engulfing candles. In 2008, we had one bear, one bull, and then two bear. And it was right after we had the bullish engulfing candle, or the green box here, followed by a red one, that we got our lights out. Remember, at the beginning of the video, we talked about how we had two bullish engulfing yearly candles, and now we got a red one. So that's like a strong signal for me. And then in 2022, we know that in 2022, we've now had three bear, one bull, and then one bear. So it's like pretty similar here. Yeah, it's like looking pretty similar. I have other notes that support my thesis here too. I didn't want to talk about this very much last weekend because I wanted to actually see the bearish momentum come through, but now we have it. So 2008 could not stage a higher weekly high after the 1 times bull, followed by 1 times bear until it lost the 200 weekly MA. So if we now go back to 2008, what that means is that, let's actually pull the chart up here. I got it here. So here is our 2022. Now we're going to zoom back in time and go look at 2008. So what I'm looking at specifically here is that ever since we got our, let's hide everything for a moment. Ever since we got our bullish engulfing and then bearish engulfing, we were unable to print a higher weekly high until we lost our 200 weekly. And that is why I think that I am leaning bearish right now. So ever since we got our high right here, we note high, lower 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 high. Higher high. That happened in July of 2008. And that was our monster dead cat bounce to come back up and test the 200 weekly before we get another bearish engulfing, and then that is where the big drop happened. So until we're able to print a weekly higher high, right now, my notes tell me that until we can print a higher weekly high, there's no longs. This is a hard penny environment. And hard pennies just mean that, this is from Mark Minervini, so he is smarter than me. Why fight for pennies when you can simply wait for easy dollars? You must learn to distinguish the difference between an easy dollar and hard penny environment. I only get aggressive during easy dollar markets. We are now in a hard penny environment. You can fight for pennies if you want. I prefer easy dollars. So this is really me just trying to show that even though we have a line chart or 91 and 85% correlation to previous trends, I want to know in more detail in terms of the technicals why these are looking similar. And that's because I am a technical analyst. I like looking at these things. I also understand the fundamentals. And we're going to look at a few more supporting pieces of evidence shortly from Ray Dalio and then also from Goldman Sachs. We're also going to look at GDP, and we're going to look at that big CFTC net short position on the E-mini futures. So far, there's like really strong correlation. It's like looking really, really strong. Now we look at the engulfing candles, very similar. And if we cannot print a weekly higher high until we lose the 200 weekly, and that actually came quite a bit after. We'll look back here to 2008. From roughly where we are right now, I would say we're about right here. We have a big, massive stomp. I think we're going to get a hammer before we actually lose the 200 weekly. That's just what I think, not that I know. And then looking here, from roughly where we are right now, or getting that bearish engulfing candle, we can note that it took roughly another 14-15% drop before we actually got that reversal, and then we got the higher high. So that means that in 2008, after all-time high, there were only red engulfing candles until we dropped, 27% off the all-time highs. In 2022, since all-time high, there's only been one green engulfing weekly candle. The rest are red. If we form the same bottom on volume, that's negative 20% off the all-time high, or 350. What is that going to be? Well, that's basically our 50 monthly moving average and our 200 weekly moving average. That's pretty much it. This is really important. All right, we're going to close this out and we're going to move forward. Now we're going to defer to two people who are smarter than me. That's right. I don't know everything. Ray Dalio, most successful hedge fund billionaire of all time. Yeah, this guy's smarter than me. This is from the 22nd or from Thursday. You are starting to see all the classic signs. Legendary investor Ray Dalio says the stock market has further to fall before a recession hits. Cool. I'm going to look through a couple of things here just to make sure that we're not spending too much time on here. We are right now very close to a 0% growth year, he said. I think it's going to get worse in 2023 and then in 2024, which has implications for elections. Just keep that in mind. We're going to look at the GDP number shortly. So this week, he was even more clear about the cost. We have got to get inflation behind us. I wish there was a painless way to do it. There isn't. That was Jerome. That pain, said Dalio, will be very sorely felt over the next few years. The Fed always has a trade-off, he said, between economic growth and inflation. With inflation now the bank's target, it will chart a course until economic pain is deemed more severe than inflation. Hopefully that makes sense to you. At that point, the bank will begin to pare back on its rate hikes. Now we play the game of what level will that hit? Is the level going to be negative 30? Is it going to be negative 40? Is it going to be negative 50? I don't know. I'm not Jerome Powell, but there's a trade-off right now. So listen to what Ray Dalio said. And now we're going to look at Goldman Sachs. Goldman Sachs is telling us that, says if the Fed nails a soft landing, don't expect interest rate hikes until something goes wrong. What does that mean? They're going to break something. They're not going to waver. That's pretty much what Ray Dalio said too. There's a trade-off. And right now, the Fed is choosing to trade off inflation for causing bigger issues. So they're not going to lower interest rates until something goes wrong. Something's going to break. And as Ray Dalio told us, we're looking for a pain level. What's it going to be? I honestly do not know. We're already down by like 24, 25% so far this year. But in 2008 and in 1973, we went down by, I believe it was like 50% this year too. So if we went down by 50 both times, is that where the pain level is felt? I don't know. But we have to be very mindful of this because so far, my notes tell me as well that we cannot get long until we print a higher weekly high. And I'm not really excited, even if there's a weekly higher high. I need to see a fundamental reason or the actual Fed pivot. So after Goldman Sachs told us that, they also lowered their end of year target for the S&P to 3,600, which is basically where we are right now. So if you're going to lose about 8 points between now and end of the year, and that's like where we're going to close, is it even worth being in the market right now? That's kind of what they're telling us. All right, so inflation rates, recession shock are not over. Bond crash in recent weeks means highs in credit spreads, lows in stocks are not over. Bank of America. Bank of America's bull and bear indicator moves back to max bearish. Investor sentiment worsens great financial crisis. When was that? 2008, baby. Whoop. Yeah, 2008. That sounds good. Let's read the last one here. Global government bond losses on course for worst year since 1949. That is like a long time before I was even born. Bond crash threatens credit events and liquidation of world's most crowded trades. What did Goldman Sachs tell us? They're going to go higher and hold there until something breaks. And we're already getting warning signs. So what does this really come down to? This really comes down to what the Fed told us. And I think a lot of people were naive or not listening. But now I'm going to just quickly explain this one more time because we went through this a number of times. I'm trying to take something that is very complicated and condense it down into an easy to digest format. So we're looking at 3 key dates here, December, March, and June. And then we got our September one, which just came in. So in December, we were told up, up, up. And just remember that where the Fed funds goes is inversely correlated to where stocks go. These lines point up, stocks should go down. And that's what we're seeing. So in December, let's look at the chart. In December, they told us up, up, up. What happened in December? Oh, crap. That's like the all-time high. That's right. That's the all-time high. We went down by... Right, we went down by, I think, 10. Yeah, we went down by about 15. Okay, cool. So where do we find our next high? Well, we bounce up into the next meeting, which is what? March. Then we're told up, up, flat. That's a pause. That's what the market priced in. Priced in a pause. Okay, what happened in March? Oh, no. That's March right there. Yep, that's March. There's our next top. That's where we got our head and shoulders at 450, I believe. Yeah, 460, right? 454. That's our head and shoulders. So this was Fed induced. And for people who don't understand fundamentals or the Fed, the line stopped going up after the Fed talked. It's that simple. So if the line stopped going up after the Fed talked, well, what happens after the Fed just talked again? December, we went down by 15. What happened in March? Well, we went down by more. We went down by about 21. So 15, 20. Is the next one going to be 25, if not more? Maybe. Let's look at the next data point here now. All right, so we got through December. We got through March. Now let's look at June. And this is where the market got relief. Up, up, down. Oh, yeah, we're not going to raise rates anymore. Jerome's got it. He's a perfect pilot. He's going to land perfectly. He's got this. What did the market do? Market went up by 20%. That's correct. Market went up by 20%. That was where the market priced in a pivot. And we went up by, I think it was roughly 20. That was our massive bear market bounce. So we went up by almost exactly 20. And then we rejected off our 50 weekly. So now we have to ask ourselves, if the market moved massively by 10, 15, 20% when we got our December, March, and June meetings, in September, where are we going to go? Are we going to go down by 10? Are we going to go down by 15? Are we going to go down by 20? I don't know. But I'm very, very, very aware that the market moves when the Fed talks. So now we're told that we're going to be going up to about 4.5 into this year, and then we're going to be pausing here. One more hike next year, and that is a lot more than what we currently have priced in. So the market is likely going to keep heading lower until we hear the Fed pivot. And the Fed's not going to be really meeting for a while. However, there's one thing I also want to point out here. Let's make sure I get my lines back. There we go. There's like a deluge of Fed speakers this week. Look here, we got 1, 2, 3, 4, 5, 6, 7 different Fed speakers, 7 different speaking events, including Powell, including Brainerd, including Williams, including Bullard twice. So what they're going to try to do, in my opinion, is just smooth out what we saw on the Wednesday meeting from the FOMC to make sure there is context. I don't know what it's going to be, but it's really interesting that 30 minutes after we have the core PCE number come out, we got Brainerd, Williams, and Mester all speaking. Right? Yeah, that's really interesting. Really, really interesting. All right, so Ray Dalio told us that we're basically going into a stagflationary environment where we're going to have stagnant growth in high inflation. That is called stagflation. This is from, I believe, a week ago on the 20th when I took this screenshot. Sorry, yeah, this is from earlier. Anyways, this is from last week. Blah, 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 right? This likely means that there's more downside to be had for the Atlanta Fed GDP model, which exiting last week called for 0.5 in the current quarter, down from 1.3 the prior week and 2.6 on September 1st. So what are we talking about? We're talking about the GDP, and a recession is technically 2 quarters of negative contraction. Everyone's like, oh, but the strong growth in jobs, blah, blah, blah. There's no recession. We look here. So in Q1 this year, we had, where's the last number here? The last number is negative 1.6. For Q2, we have negative 0.6 for right now. We're going to get a revision on the 29th, which is Thursday. But the important part is that we've already had 2 quarters of negative contraction. And that number we just looked at, 3 weeks ago, it was 2.6% for growth. Then last week, it went to 1.3. Then it went to 0.5. Do you want to guess what it is now? It's 0.3 as of September 20th. So if the trend remains, and when we get this data print in October, it is negative, what is that? That's 3 quarters of contraction, which I don't think we've actually had for ever. I don't think we've had, we get 2 quarters of contraction. Here we have multiples in 2008. I don't know if that's 1 quarter or not, though. So all this means is like, man, this is like not looking good at all. Yeah, that's correct. This is like not looking good. And Ray Dalio said that he's not expecting softness just for 22, but for 23 and 24. What is that? That is a deep global recession. Deep global recession. That's what he's talking about, right? Whoa, that's like what we heard is like maybe Fantasyland not that long ago. Now seems a lot more likely. 0.3 is really soft. If it keeps the trend, like I mentioned, this is going to be negative by the time we actually get that print. And this is adjusted on the 20th, so I'm assuming we'll get another revision this week, and I will be paying very close attention to it. One more thing I want to point out here is just that the CFTC net positioning for the E-mini futures got reduced by about 20%. So the previous week we had about 281,000 contracts short, and now we got about 219, which is a reduction of roughly 22%. Why is that important? Because if we look back to when we had the 2020, again, in July, which is when we started to basically go back up, the big short got removed, then went to net long, and that signaled the bottom. Same thing in 2019 here. So is one line enough to say that this is a trend? No. But this is the lowest level we've seen in quite some time. So the last time we had a level this low was in July. And July is when what? We started going back up. That's correct. So I think we're due for relief. I'm not sure this week or next week. I'm not smart enough to know that. All I'm trying to do is just get prepared. So I've pretty much gone through most of the important stuff I want to go through here now. So now that we've noticed what we mentioned for, let's actually go to here. We'll look at some more charts. We'll look at some options, and then we're going to sign off here. So for key dates this week, oh boy, right? This could be very, very hard to predict. But what do we have in here? We got geopolitics. We got Biden hosting the Pacific Nations. We got 1, 2, 3, 4, 5, 6, 7 different Fed speaking engagements. We got German GDP or preliminary coming in at what? 0.1% is the number. Wow, that's like stinky. Yep, that's stinky. ECB Lagarde's going to speak once, and then I think she speaks again. I don't know if I included it here. I think she might only speak once then. We got European CPI coming in on Friday at 5 a.m. And then we got core PCE coming in on Friday. Jerome was scheduled to speak on Tuesday as well, but I went to the FOMC website, and I see him on Wednesday at 10:15 giving opening remarks. What I will pay attention to this week are the red numbers. So Fed Chair Powell speaking, GDP numbers, does it get revised up or down? Core PCE, but then the Fed speakers are also important. Notably, Bullard talking on the 27th and then also on the 28th. Why? He's been the most vocal hawk on the board, coming a little bit back towards neutral, and I'm not sure what we're going to hear from him, but what I want to really listen to is whether or not he is saying that we currently have enough hikes priced in, or if we don't. That's all I'm really going to pay attention to. And what this comes down to is basically a chart that we have here from Goldman Sachs. Thank you, Mason, for sharing this. We have this one right here. So Goldman Sachs now expects 75 in November, 50 in December, and 25 in February for a terminal rate at roughly 4.5%. Is that enough? I don't know. But Goldman Sachs is pricing a little bit higher expectation for 75 than the broader market. Market pricing is 66 for November. They think 75, 50, and then 25 for a terminal rate of 4.5 to 4.75, which is just below 5%. Something's definitely going to break. I don't know if it's going to break before we get to Feb 2023, sorry, or earlier. There's already all these warning signs. So if we keep that in mind, there's going to be Monday, Tuesday, Wednesday, Thursday, every day, every single weekday this week, there's going to be an important market-moving event. Is it going to move the market? I don't know. But we have to pay attention to it. Next thing here is why bull or bear. You're going to note that the bull case is pretty much all crossed out. Why? Shallow recession is pretty much not an option anymore. Jerome confirmed it. He said there's going to be pain. He's not going to use the word recession, but he said businesses and people or American citizens are going to feel pain. There's going to be below trend growth. He's talking about a recession. He's just not going to say it. Bear market, super strong. I don't know what else to say. It's strong. And then surprises. What does the Fed actually say? And then inflation, meaning on Friday when we get the CPI from Europe and the PCE from the US. Looking at our bear market targets. If we get down to 350, that means that we probably lost 360, and what I'll be watching for is the velocity down. Like I mentioned before, after we lost 390, like a magnet, right to 380. After we lost 380, like a magnet, right to 370. After we lost 370, like a magnet, right to 360. If buyers do not show up at the low of the year at 362, like the shorts did, they covered some, I think that we're going to slice down to 350. There should be very strong support there. I personally do not think it's going to hit this week. I think we're due for some relief, but if it starts to happen, I'm going to believe my eyes. Finally, probably the most important slide here is going to be my notes. These are my personal notes to myself. Hopefully you benefit from them too. And this tells us that higher highs, I'm just going to exclude the fundamental part because I pretty much all got confirmed this week. Technicals, 2008 and 2022 parallels. Absolutely. It's looking stronger, stronger, stronger. Our algo says to invest in being short. Those are the easy dollars. And until SPY can print a higher weekly high, there are no long positions for me. That's it. It's that simple. We're going to look at the options chain for next week. And I would also note that Friday is going to be the last calendar day of the month. So where we close is going to be important because it's going to be the last day of September. We're going to get that monthly candle close. And what I really just want to pay attention to here, because the numbers are obviously very big. We can look here at where the volume is, 370, right? We got 365, we got 360 with 100,000 in volume here, 100,000 open interest. These are massive numbers. What's missing here? Open interest. There's volume at about 370 to 375, but it's only about a third of what we see on the put side. So everyone is positioned short. Everyone's looking one way. That's why I think we could be due for relief. What I want to look at here is going to be how much premium is priced in for 7 days. Because with the VIX over 25, I think closer to 30 now. Let me actually just double check. Yeah, VIX is at 29.9, so it's up 10% on Friday, which means we're probably pricing in about a 1.5% implied daily move at the money, or about 368, which is where SPY closed on Friday. Yeah, 368. 368 has $6 in premium. So what does that mean? Excuse me. 368 minus 6 implies, oh my goodness, an at the money, not even out of the money. An at the money put implies that by Friday, we're going to be back at our 2022 low of the year. There's no point in looking at more options because it's clearly bearish. It's clearly skewed to the downside. I actually just want to look at one more thing here. I want to look at the October 21st monthly chain because we looked at this one before. Let's hide this one. Don't save. Right? Where's the bulls? Yeah, a little heart for the bulls, right? I don't know. Bulls seem a little bit MIA. What's happening here? 375, 370, 365, and lower. I'm sure if I went beyond the 16s or be even more, biggest strikes are what I would also expect. For the next 30 days, at the money, or 368, we're pricing in $11. So that means that if people are expecting to get their money back, they're thinking that we're going to be at 357. What's 357? Well, we talked about that. Let me see if I can actually bring it up here. 200 weekly. That's correct. So let me actually just see if that's still the number we got here. Yep, 357, 358 should curl up very slightly. So what does that imply? Well, it implies in the next 30 days or the next month, we're going to be at that 200 weekly. So it's skew bearish. The numbers match. 362 by Friday if at the money gets their money back, let alone making anything. And then we will be at or below the 200 weekly if in a month the at the monies are going to get paid up. All right, so we're going to wrap up by looking at a few more charts. And there was actually a lot more I wanted to go through this weekend, but I'm choosing to try to keep the video a little bit tighter so that it is it's digestible and you guys understand where we're likely going to go from here. So SPY closed in bear market territory for only the second time this year. If we don't get that immediate snapback like we did here in June, I think we're going to be going lower. Volume is elevated and implies down. Looking at QQQ, we're already at the 200 weekly. So printing a weekly lower low means that we're going to be below the 200 weekly. We're also closing inside of negative 30% territory. That's pretty bearish. DXY, 113, it just can't stop. It's up by 3% this week. So SPY being down by 4.5 means that 2/3 of those losses come from the dollar going up. This thing just won't stop. It's so strong. VIX is over 30 now, almost poking back inside its elevated area. If VIX gets back above 30 and starts making progress higher, that implies that we're looking similar to where we had that that big crash in 2020. Look at the 2-year note. Whoa, whoa! It's up to 4.2%. Elon Musk would be proud, and it's up by nearly 9% on the week. Massive week, massive. 10-year note. Invalidated the head and shoulders. New 52-week high. New multi-decade high. Yep. It's all the way back here to a level we've not seen since 2011. Wow. Golden cross, powering up. It's just going higher. Inversion also at a... it's also going up this week by about 1.6%. Not as important, so we're just going to skip it. I want to know what's happening here to Bitcoin and to... Actually, I want to look at the DAX first. I want to look at the IWM. So IWM is now flashing some warnings as well, because we note that we are now below our 2018 and 2020 highs. And these are small companies. They're generally going to have a harder time in pricing power with inflation, and they're likely going to be leading us down. So this one here, already saying we're likely going to be going lower because it's closing below the 2020 and 2018 highs. Now, if we look at the Dow, which I've been mentioning before, is already leading the decline. It's right back here to its 2020 highs. Yep. So it's back to its 2020 highs. We got a weekly candle close below the 200 weekly. Also, our weakest close of 2022. This is implying down. What's missing? Volume. So the Russell, the Dow, already signaling that there is trouble ahead. Now, if you look at the DAX, which is the German market, what's it also doing? Interesting. It's not only below 2018 and 2020 highs, it's all the way back to 2015, which means we've now basically puked up 7 years worth of gains on the DAX. Lower, lower, lowest. Cool, right? This is so optimistic. Yep. One thing to be a little optimistic about is for the crypto bulls who I think that, I mentioned this on the previous weekend videos, I think about a month ago. I think that Bitcoin is going to start stabilizing. That's just because of the psychology chart. I don't want to bring it up now to start confusing people, but I'm watching this 2018 high at about 19,800. We're not that far off of it. It ripped back up violently, about 10% after we got that Friday close on SPY. Looking at ETH, also really close to my 1420. So I think that we're going to start going into the period of frustration where we go sideways. I'll actually just briefly show what I'm talking about here so people can understand. So going back to again, this is my personal account, Justin Karan. If you go to here, when SPY was at 422, I was looking for the breakdown, which has now happened. We look over here to BTC. BTC was at 21.3 at the time. I was looking for support to stabilize around 19.4. We went down to about 18 something. I think we're about right here. Poke below, come back up. We're still trending down, but we're hovering. I think most of the lows are already in. And then ARK. ARK is now, I believe, at 37. So it's actually going back to test this lower low here. And it's probably somewhere inside of here. All right, just a few more charts to look at, which are going to include what? The trillion-dollar companies, because if the market's going to truly drop, and QQQ, or the Qs, are now closing right around that 200 weekly, we have to look at the strength of these charts. Oh, wow, Apple actually rejecting off of the 50 weekly with an inside bar, which means if it's going to go lower, that would be the kiss of death here, where it rejects off the 50, and now it starts to go down. So I'm already seeing a warning sign here on Apple. Microsoft, it's now back to its supply pocket or this yellow box, and we note that we have another lower low on a weekly closing basis. Volume is elevated for the last 2 weeks, but overall, it doesn't really look terrible. Goog, this one was starting to look terrible. This one's lost its zone. It's lost its demand pocket where people want to buy, and lower. I don't like that. Not really a lot of volume yet either. Amazon, just having a hard time. It's right back to where we were about, I don't know, in July. And it doesn't look terrible. It's still printing a higher low versus the carve-out we put in the last earnings report 2 times ago. It's not looking great. 2018 highs, 2020 highs, we're right around there now too. Tesla, yikes. Bearish engulfing weekly candle with what? A rejection off of the 50 weekly. They have AI. I think they got their AI day this week. I'll be watching really closely. Tesla does not have a lot of volume here. So if it starts to really fall and volume comes in, that'll confirm the move for me. I'm already seeing the same thing on our two last leaders, meaning Apple and Tesla here, that are giving me a little bit of a warning. Meta, stinky, stinky, stinky. There's nothing to say. Its stock stinks. Nvidia, closing below its 200 weekly with a lower low and a lower high with elevated volume. That is a warning. And that's it. So we're not going to watch, we're not going to go through anything else. I thank you very much for watching. And if you want to know more about my original bear market thesis of 2022, I will queue up a video here at the end. Otherwise, I thank you so much for watching. I would really appreciate a thumbs up. Drop me a comment and subscribe to the channel if you have not already. Thanks so much. I look forward to seeing you on Monday.